Hello, everyone. Thank you for coming. For those that they come for the first time, we are the Global Value Investing Club. We have groups in several cities, but the most active is London and Malta. Just let me tell you that we are always free to talk and say our opinions, but you should never take what we say as a recommendation. So you're free to talk, but whatever we say here is not a recommendation for buying or selling. So keep that in mind. Now you can go on cityfalcon.ai/meetup, and there you can always find the presentations for the past meetups. So you'll see that there are many companies, and also you may see the performance of the ideas that they were presented. So here, like something that catches my eye is that on February we presented some tech companies because of the AI hype that was going on and the old talk about ChatGPT. That was on February, and interestingly, you see these green numbers. So all those companies that they're about AI, you see that they have performed well. Do you think that this is just the hype and they're just excessive valuation? Yeah. You don't think that there is too much ground or no? Okay, you can expand on that if you want. You want to say 2 words?
Well, with every emerging technology, there's a lot of hype. We saw that with the crypto bubble. Yeah.
Okay. That's an interesting opinion. So just let me put. And we also talk. This is the graph. Sorry if you cannot see, but it's a graph for NVIDIA. And in the previous meetup, we talk about NVIDIA, and it was one of the stocks that initially people didn't think that it will do well, but it does well as a stock. And also we see maybe it's excessive valuation, but also we see the real numbers, the earnings. They are there is an explosion in earnings, and we see also that GPU demand is huge, and there is a scarcity of GPUs right now in the market. So these are some real, let's say, facts. But maybe again, maybe the markets are overreacting. Any thoughts on that? You're always free to say anything. Anyway, we want this to be like a discussion. And as always, we present the performance of S&P 500 because it's the index, so it shows where the price levels of the stocks are. But I prefer to put a graph of a 5-year graph. So you see that now maybe people are not so happy. Welcome. They're not so happy about the current performance. But if you see like the 5-year performance, especially for the S&P 500, is pretty good. Probably we haven't cut the highs, but the prices are doing well. Any thoughts on that? Do you think that stocks are expensive right now? They are not. You think that they are expensive? Okay.
I think
Yeah,
I think the overall index is expensive, but it's weighted or driven by the top 10 big, large tech companies, which are like 30, 40 times P. If you remove that, I think the rest of the market is like 15 times, which is fine, I think, roughly.
and you can read my mind because I will go to the to the AIM index. This is where I'm investing, where I think that there are many opportunities, and you will see like a different. So if you think that some of these companies have grown, they're almost 4 years that they have 3 years since COVID, and you see that. I think that when I see valuation of small caps, especially here in the UK, I feel that the valuations are really close to what we saw during the flash crash of COVID. Do you have the same idea? Is anybody investing in AIM small caps here in the UK? Who is investing? A few people, yeah. Do you feel the same, or it's only my companies that they are tanking? Yeah. Okay. Um, so I will go and also today we have a presentation of a UK small cap from Ildar. So it will you. So I just want to say a few things about the interest rates, because we see the inflation that it's cooling now. Like if you see month by month, it seems that it's cooling, but the interest rates are, the central banks have increased the interest. Do you think that they will soon stop? Do you think that or even decrease the? What do you think? Any thoughts on the interest rates?
So I think in the longer term, I think they're going to decrease the rates. I think if we start to have a recession, if we have lots of unemployment, they would rather choose inflation. So I think this is temporary. The system's become quite used to low interest rates. So, I mean, there's a lot of bubbles out there, and I feel like if interest rates go a lot higher, everything could come crashing down. There's also a lot of leverage out there.
Just to expand on what you said, I think that when the inflation was higher, now if let's say the prices have cooled, now we tend to have a negative real interest rate, so that might affect further. I think I'm not a macro person, but yeah. But I guess that we will talk more about the interest rate later when we will have the presentation of Pietari that is on a European bank. So I guess he will talk more about interest rates, and we might have some more insights there. I just want to say a personal opinion, which might be a bit unconventional. If you see the ECB, the European Central Bank, um, they were about late in dropping interest rates in zero and for the QE, and you see basically that they had to keep the low rates lower. So something that I find in interest rates, and I won't say much about it, but it's that low present rates promise higher rates in the future, and the opposite. If you have increased interest rates, we can discuss about this later. So my unconventional idea is that if we had a more easing monetary policy earlier, like we did, not to the extremes that we did with COVID, but I think we might create some inflation, and then some higher interest rate could be sustainable, because there is a lot of criticism that interest rates stayed low for long. But I think that if the monetary policy was a bit more expansionary, more than it was, then it will create some inflation, and some inflation will give some room for higher rates, which is a bit unconventional. I don't know if you have anything to say about this. Yeah, right.
15% already, wasn't it? So it couldn't really go much more without there being a lot of trouble, a lot of outcry. You don't want inflation going to, it was 15, 16% already. If you, on RPI, not what they actually tell us, but so how high could it go? So they probably, you could say that they've even raised rates, especially in the UK. They've possibly raised them a bit later than they should have, but that's a matter of opinion.
Yeah. I'm just my thinking was like, if we did what we did with COVID, not in such an extreme way earlier, like if we were a bit more my thought was that probably we will have created some inflation earlier, and then we could sustain higher interest. That's the idea. Any other thoughts generally on interest rates, and then we can go to the presentations. Or on, if you have any thoughts on the current environment or the economy. I'm not a macro person, but if somebody wants to share anything, any opinion, I'm happy to listen to it. Okay. So how do you feel right now? This is like something that we always ask, and we want to historically catch like how people feel about the market right now. Do you feel fearful or greedy? If anybody wants to share.
I mean, if you're buying the market, you got to worry about the macro. But if you're buying individual securities, you just worry about them. You don't think about the macro. You're quoting Warren Buffett, like he's famously said he doesn't think about macro when he's talking about his individual stocks. So it depends who you are, you know.
That's so true. Any other opinions? And also Warren Buffett has said that, I care about things that they are predictable and important. So macro are important, but we cannot predict them. So I also don't take into account macro, but I always find it interesting to discuss them because it helps the understanding of the general economy. Okay, so yeah.
Interest rates do stock market, and that's interest rates do impact the stock market. So it's not as if that's a macro. It's yes, it's macro, but the underlying it will bring everything down if the interest rates go up.
Absolutely. It's just difficult to predict those things. Yeah. But absolutely. Yeah. So we have Pietari Laurila, who is a popular investor in eToro, and he invests on eToro. And he has around 30,000 followers and 3,000 copiers, right?
That's right, yes.
Yeah. And he's a value investor, but you also take into account macro. So
Yeah.
from you, we learn a lot about macro. And he will talk about European banks. Okay. So the floor is yours. Thank you.
Okay. All right. So European banks. But before we start, just like very, very briefly about my background. I've been investing for about 20 years. I've done day trading. I've done microcap stocks, and then bigger stocks. For the last 5 years, I've been investing in banks. But before we talk about why banks might be a good investment today, let's entertain some counter arguments. Here is a statement from a value investor I respect from his first quarter investor letter. So he says proudly that we have no exposure to banks. And he gives a few reasons for that. And number one is liquidity risk. So banks are a little bit different from other types of companies because they are very confidence-sensitive businesses. So as value investors, we normally like it when stocks go down. Then you can buy the same company more cheaply. But with banks, it doesn't always work like that. So if the bank share price falls, and as a result of that, people lose confidence in the bank, then the bank can fail. And that is exactly what happened this March. We had the Silicon Valley Bank collapse. In March, on one day, the share price of Silicon Valley Bank, it fell 60%. And obviously, it was all over the news on that day. That accelerated the deposit outflow from Silicon Valley Bank. And then the next day, the shares didn't open at all. And it was 100% loss for shareholders. So you had one day to get out at a 60% loss. After that, it was 100% loss. So this is obviously something that not many people are comfortable with. All right. So the second reason this same value investor gives why he doesn't invest in banks is that bank balance sheets tend to be opaque. It's difficult to know who the bank has lent money to, how much, and if those guys are going to pay the money back. And now if doubts start to arise about one bank, then unfortunately, frequently it spreads very quickly to the entire banking sector. So we know when that happens, then all bank shares fall a lot. In 2008, bank shares fell 83%. And it didn't help even if you invested in the good banks. So let's say you knew that JP Morgan, say, that was a solvent bank. They hadn't invested in those dubious mortgage-backed securities. You still lost 65% of your investment. Now, banking is an industry which is famous for attracting the kind of people that are in it just for themselves. And this can happen even with banks that are kind of good banks. So here's one example of Swedbank, which is a Swedish bank. It's a retail bank. It's a good quality bank. So it's not the kind of bank where you would expect to get into trouble. But in 2019, it was in the news that the Baltic subsidiary of Swedbank, there was some money laundering going on there. So it was first in the Swedish TV. That's what caused the first drop in the share price. And after that, it was in the news that the Swedish prosecutors raided Swedbank. So what happened is that investors lost 33% of their capital. Another reason to avoid banks is that it's just macro. So in banking sector, what moves these bank shares is frequently interest rates and also investor expectations about the health of the housing market and the health of the commercial property market. So if you invest in sectors like consumer discretionary or technology, then individual stock analysis is hugely important. But in the banking sector, although there is a role for individual stock analysis, then macro factors tend to be more important on a day-to-day basis.
Okay, move on. Wait, please.
A few weeks ago, Italy announced a bank tax. The government said that the banks are making too much money, and so they want to take some of that away. The same thing happened last year in Spain and in Hungary. Banks have a bad reputation as a result of the global financial crisis, and now some people are saying that banks are basically uninvestable because if they're doing well, then the politicians take it away. If they're doing badly, then the shareholders take the loss. Either way, the shareholders lose. And finally, from a longer-term perspective, you have more competition in the banking sector. The big banks, they are kind of legacy businesses, dinosaur businesses. You have like more nimble competitors now, which don't suffer from any legacy offices, staff, infrastructure. So they can offer some services like payments, FX more cheaply. And some people are saying that new technologies like blockchain, they could disrupt many areas of banking, like payments is a good example, trade finance, securities settlement. So as a result of all of these problems, then banks have not been the place to be for a really long time. So this chart shows the history of the European Banking Index since 1988. And you can see that since 1998, so for the last 25 years, you haven't made any money whatsoever investing in banks. So this is a terrible track record. So why, despite all of this, am I here today to argue that banks might be an interesting investment today? A big part of the reason is this chart, which shows the evolution of interest rates, specifically German interest rates, over the past 25 years. So interest rates were on a long downward trajectory, which started in the early 1980s. And there are good macro reasons for that downward trajectory. So you had the integration of China into the world economy during this period. That increased the supply of labor. And you had aging demographics, which increased the supply of savings. But now some people are saying that some of these trends might be changing. Some people are arguing that there is a great demographic reversal. Also, what is happening is that there is the green energy transition, and that requires a lot of investment. So you can finally make a plausible case that now the supply and demand of savings has become different compared to the past 20, 30, 40 years, and that should increase interest rates going forward. There is an active academic debate about this at the moment. It's definitely not a settled question whether this will for sure happen. I personally, however, lean towards the explanation that it will happen and interest rates will stay higher this decade compared to the last. So if this happens, then that's very good news for banks, because banks make more money when interest rates are high because of the zero lower bound on deposits. So it's very difficult for banks to charge negative deposit rates. So now that interest rates have increased, then that problem has gone away. And that is something that you already see in the data. So bank profitability, which was in Europe at around 8% ROE or return on equity after the global financial crisis, it has finally now moved higher, and that is simply because of the higher interest rates. So now we have moved from 8% profitability to around 11% profitability. But what is interesting is that if you look at the dark blue line here, then the valuation of the banks has not moved in line with the improved profitability at the same time. And what that effectively means is that the banks now trade at very low PE ratios. At the moment, the entire sector trades at 6 to 7 times earnings. That is much lower PE than the sector has historically traded at. And you can see on this chart that these kind of valuations, you last had them in the global financial crisis in 2008, and also in the European sovereign debt crisis in the 2011 and 12. The difference now is that at the moment, there is no crisis. So you can buy banks at crisis valuations while there is no crisis. But would there be some good reasons for these low PEs, the low valuations? Now, we go back to basics, and we look at what determines PEs for any company, any sector, or any country. So PEs are determined by 3 different factors: growth, the payout ratio, and the cost of equity. In terms of growth, banking is a mature industry, it's a low growth industry, but it's been like that certainly since the global financial crisis. I don't think that anything much has changed in the last 5 years. On payout ratio, we have more inflation now, which is bad for the payouts. However, as we saw on the previous slide, the profitability of the banks has also improved, and that is good for payout ratios. So if you put these 2 things together, then you will find that the payout ratios today will be about similar as before the before the pandemic. So again, there is no real reason to argue that the payout ratio would be an explanation for the low valuations of the banks today. The banks, yeah. Oh, it's the amount of like dividends and share buybacks as a percentage of the earnings of the bank. So the banks pay about 8% dividends today. That's a good dividend yield. So that then leaves us with the final factor that determines PEs, which is the cost of equity. And cost of equity is determined by a few factors. You obviously look at the overall market cost of equity, and then you look at more some bank sector specific factors. If you look at the overall market, the cost of equity is low. We all know that valuations are in general pretty high at the moment. You can't say that banks should be cheap because the market itself is cheap at the moment. Or if you look at more bank sector specific macro variables, there's credit spreads. You have the private issuer credit spreads and the public issuer credit spreads. So here I show the private issuer credit spreads, the euro area high yield credit spreads. So you can see that at the moment, there's no concern on that. So the credit markets are saying that the risk of recession is pretty low. The risk of defaults is pretty low right now. It's a very different situation to 2008, 2011, or even the mild recession of 2000. Another very important factor for bank valuation is public sector credit risk. Because if a country like Italy defaults, banks are not going to do well. All banks have massive amounts of government debt on their books. But you can see on this chart that the credit risk of Italy at the moment is at average levels, is not anything like it was in 2011 and 12 when the European sovereign debt crisis was there. So again, you can't use these credit spreads to argue that banks should be very cheap now. So you have to look for some other explanations. Some people are saying that there's going to be a recession soon. Personally, I don't care, because we can see from stress tests that the Bank of England, the European Central Bank, and the Fed run, that the banks are very resilient in any ordinary recession. Interest rates could go back down to zero, so all the profitability could go back down to 8%. It's possible. It's a credible argument, but personally, I don't believe in it. You have regulatory factors, but much of this stuff is known. And the kind of stuff that you need to be worried about as an investor is the stuff that nobody knows about, that nobody talks about. But the regulatory headwinds that we are getting over the next few years, they can be modeled, and I think those are, to me, not a concern. We already talked about political interference. That can also be modeled. After the tax comes into effect, the share prices fall, and then you can say that, okay, maybe the effect of this tax is 5% of the share value. The shares already fell 5%. It's already in the price. So I would say that the most important explanations are actually the last two. The banks lost 80% in the 2008 crisis. They lost a lot in 2011-12. So now obviously people are very wary about these banks. That's understandable. But as value investors, we need to go to places where other people don't go. That's the only way to make money in the market. You have to buy stuff that other people are uncomfortable with for whatever reason. And the final one is the fact that there's a lot of debt in the system. Interest rates have increased. Is this going to lead to a financial crisis? No, it might. And this is the one that kind of keeps you up at night. Is there going to be something there? Nobody knows, because it's like a butterfly thing. These things are non-linear. They can't be modeled.
If you want, you can use the microphone, like you can go close. I can do it for you, but just for them to be heard, like, because the microphone. You can use this one. Pietari, here is the mic.
Yeah.
So you can use this.
Okay.
Yeah. Sorry. Yeah.
Okay, so yeah, the micro. No. The reason Silicon Valley Bank went bust is because the assets went down in value. They had government debt, which was long duration, but went down in value, and they turned into negative equity. And everyone could see that even though they didn't have to market their balance sheet, the balance sheet was wrong, like it was negative equity. And earlier you just said that European banks are full of European debt, and the European government debt market is much longer duration than the US debt market. So they probably have longer duration debt on their books, which has gone down in value because you've shown us the graph of interest rates going up. And so I infer that there must be lots of European banks that if they properly marked to market their balance sheets, they would have negative equity or close to negative equity. That would be the thing that I would be worried about.
All right. Yeah. So one of the things that was a problem in the US was the bank regulation, which was not good. So the European bank regulation is a bit more strict. So you don't have the same problem, the specific problem that Silicon Valley Bank faced. But yes, there's also like debt which is held until maturity, which is held at original cost. So yes, you can have some problems potentially with that. So I mean, yeah, it's a risk that you have to accept. All right. So yeah, so the financial crisis is really the kind of thing that keeps you up at night as a bank investor. So what you would really like to see is that the interest rates are going to top out here and are not going to go higher, because that really determines the kind of risk premium that investors are going to require for the financial crisis risk. If interest rates still have to go higher, then that increases the risk for the financial crisis. If they stay at current levels, then it's better. So here's like a few potential ideas of European banks which are very cheap right now. NatWest is a UK bank, retail bank, trades at 5 times earnings. So British banks are some of the cheapest in Europe right now. The UK has the worst growth inflation mix compared to Europe or the US. So that explains some of the cheapness. NatWest also has had some of its own problems, but the CEO recently had to resign. And the regulator FCA is putting pressure on these banks to increase their deposit rates. So we are contending with these problems, but on the other hand, the valuation is 5 times earnings. So is it already in the price? You have Banco Santander, 5.5 times earnings. The historical average is 9 times earnings. So this is like part European bank operations in Spain, UK, and part an American bank. So they have big operations in Latin America. But it still trades like a European bank at this kind of valuation. Or if you want to take on a little bit more risk, you can move beyond the retail banks. You can take a look at some of the investment banks, which are also very, very cheap. There's Société Générale, a French bank. Hasn't done well this year. They've had a bit of problems with their balance sheet management. But those headwinds should abate next year, and the valuation again 5 times earnings. Or you have the bank that everybody loves to hate, Deutsche Bank. So this bank, it didn't make any money over the past decade, but now the turnaround seems to be gaining traction. It's helped enormously by the higher interest rates, and the valuation is again, it's kind of like 5 times earnings or even 4 times earnings if you go to 2025. So if you believe in the turnaround, if you believe there's no financial crisis, then at some normalized valuations, this should be 50 to 100% higher. So overall, I would say, in my opinion, the European banks, the risk reward is attractive because right now there is no crisis, but at the same time, you can buy these banks at crisis valuations. I like European banks a lot more than US banks. I don't like US banks at all. They are much more expensive than the European banks. And also the trends are worse in the US because there's more competition for deposits, and you've seen the earnings estimates for quite a lot for US banks. Also, even the regulation, which was a headwind for European banks for a long time, now it's actually becoming more of a headwind for US banks. So whichever way I look at this, I prefer European banks to US banks. And I personally strongly believe that you can make a lot of money off this over the next 1 to 2 years. Perhaps the catalyst would be that the market gets more confidence that the interest rates are going to stay at current levels and are not going to go higher, in which case the risk of a financial crisis is going to go down. Thank you.
Thank you so much. Thank you.
And one of the reasons that the housing market crashed, well, I feel like the housing market in this country may crash because property prices are at historic highs, and a lot of people are not going to be able to afford the higher interest rate when their mortgage resets. And just like in 2008, I feel that if property falls, the bank is exposed to that in a big way. And I feel that there's like a lag where you know, so for example, like my parents have a mortgage, but theirs isn't going to reset for a couple of years. But eventually when it does, at these high interest rates with higher fuel prices, higher gas prices, just a higher cost of living, I mean, my parents are okay, but a lot of people may not be able to afford to pay their mortgage. And if you're a bank that holds lots and lots of mortgages, that could be like a massive risk for you, similar to 2008. So do you have any thoughts on that? Is that a risk that you've mitigated in some way by, you know, shorting in some other direction, or?
I agree with you 100% that property, in my opinion, in the UK is overvalued. We've seen a massive step change, a sea change in the level of real interest rates over the past couple of years. So we've gone in the US, I believe, from like -1% real interest rates at the 10-year level to like +2% now. So as a result of that, I think real property prices will fall massively. Probably at least 20-30%. And it's going to be a gradual process because nobody likes to sell their property at the loss. The market is not very liquid. A lot of people still have cheap mortgages. They don't need to like act quickly, etc. But eventually that correction is going to happen. However, what I do think is that we are going to have some inflation during that same time period to offset some of that. So maybe the real property prices will fall 25%, but at the same time, the nominal property prices will only fall by 15%. Or if it's like 30% real property price fall, then it's going to be 20 or 25% nominal. And this kind of level of a property price fall is modeled in the stress tests. So you can already see like what will happen to these banks when house prices fall by 20% nominal. So it's actually much better for the banks when there's high inflation with these kind of secured assets, because then the value of the security, although the real price of the security falls, then the nominal price can kind of stay, maybe not stable, but at least not fall as much. So I think this will give these banks protection. So that's my opinion. So that's why I'm not like super mega worried about property crash. I agree that they will fall, but I just think that banks should be able to cope with it.
Very, very useful insights for. I'm sorry. No, it's working. It's fine.
I'm not worried about the property prices, but you didn't mention Credit Suisse, obviously a European bank. For some of the more esoteric Italian or French banks, do you think the governments would or central banks would do a bit of a Credit Suisse were there to be a bank run? Because that's more my concern. In particular, Deutsche, the obvious sort of bad apple, maybe.
So it's interesting that you mentioned Credit Suisse, because that was one of the banks which frequently came up on my screens over the past couple of years. So it's screened as very cheap. But I never invested in that because with banks, you do have that like a liquidity risk. So you kind of want to be invested in more the banks which are kind of stable or improving. With Credit Suisse, I always had the feeling that they are going in the wrong direction. So that is the kind of bank to avoid. If the bank is cheap, but it's going in the wrong direction, I'm not going to invest in that one, no matter how cheap it is. It doesn't matter if it trades at 5 times P, 3 times P, 2 times P, or 1 times P. It just doesn't matter. Now with Deutsche, I feel it's different, because I feel that yes, it's been a bad bank, but I feel it's going in the right direction. So I got a very different feeling on Deutsche compared to Credit Suisse, and that's why I'm happy to invest in Deutsche. So that's the kind of difference. With Deutsche, the market tested them in March. So when the US banking crisis broke, then Deutsche share price went down quite a lot, and people started speculating against the Deutsche credit. So they were selling short like CDS. So that's exactly the kind of strategy like where short sellers will try to create a crisis of confidence in a bank to make profit out of that. It's a bit unethical, but people do that. But at the end of the day, Deutsche came out of that fine. And then when they come out of that fine, then it kind of strengthens the confidence that people have in the bank. So now it's just slightly more difficult to speculate against Deutsche in the future, because they already survived quite easily like this one crisis in March. So I was out of Deutsche in March because I wanted to see how it pans out. But I've gone back to Deutsche after that when I saw that the situation has stabilized.
So, like, if you have a, if you have a question that you really want to ask, you can ask one more. But it's better, I guess, to go to the next presentation, and then at the end you can ask like combined questions, and we can talk more. But if it's something last that you wanna add, that's fine. So we can go to the next one, right? Okay.
Yeah, okay.
A few words for you. So Ildar is gonna present Kistos. I'm a fan of Ildar. Ildar has a blog, the hidden value gems, and I'm a fan of him. So he presents some great ideas about value investing, and I'll let you talk more about all
Okay.
of those.
Yeah, thanks. No, thanks a lot. And I've been coming to these events since maybe 2019, before COVID. So I think we knew each other for we have known for like 5 years or so. And so, yeah, I'm similar to Pietari. I have about 20-year experience, although I haven't been investing that actively since early days, and I've never been a day trader, but I know a lot of value investors who actually, or fundamental investors who actually embrace this concept more recently. So maybe I should try. And last 15 years, I've been on the sell side. So I did cover oil and gas as part of my full-time job, but I never officially or formally covered UK E&Ps or North American. So the experience was with the emerging markets primarily. So the structure of the presentation, so the 4 key parts. So I'm going to talk briefly about the sector, then why I like Kistos, its valuation, and the key risks. So I think oil and gas is well known for destroying value. It's been like last decade was awful. And I think, the best example to say how bad this sector is if you take the price of oil, convert it into or compare it to a retail price of a mineral water. In most cases, you'll have mineral water selling at a higher price, and the costs that it takes to deliver that barrel of oil are way more significant compared to any mineral water. And you don't have any brand loyalty. You face massive costs up front, and you have severe kind of uncertainty. You don't know what the product you will sell in the next 5-10 years at what price. However, the 3 things have changed, and I think these provide great setup for the next, I don't know, 5 years at least. So the ESG, energy transition, and capital discipline. So ESG basically makes everyone nervous in the sector. It's very hard to raise capital and very hard to sanction new projects. We've had many cases in the US and Europe where basically various activists put brakes and put pressure on companies not to go ahead, as well as politicians. So it's basically, I wouldn't say it's toxic, but it's a bad sector to deal with. Energy transition is the same thing, is basically you don't know what will be the oil demand in 5-10 years, and most of these projects, to start a new project, it's you need to pay back, you need to forecast for the next 10-15 years. If you don't know what the demand will be, you probably will stay cautious as an operator. And that goes to the third point, which is for the first time ever, or at least in the past 20 years, companies are not prioritizing more spending. They in fact prioritize. Sorry. They prioritize buyback and buyback. All right. Yeah. No problem. So and this is just to support the first argument. So this is the sentiment. The underperformance has been significant. I think you're quite aware of this. This is the capex trend. So we are actually more like here. So it's been a downward trend for let's say 10 years. This is the rig count picture, quite similar. So the number of rigs in operation globally, it's been declining. This is the structure of how companies spend. So the orange is the dividends and buybacks, and you see the share is increasing. And this is also an interesting chart. It's maybe a bit what Pietari was referring to in terms of the long-term trend. So this is the S&P energy or oil and gas for the past, let's say, 20 years. And so first 10 years from 2000 until 2010, the sector has done really well. It was up 3 times, way better than the broader market. It has actually outperformed significantly, even though the average oil price was only $50. Then the average oil price moved to 80, but the sector has done nothing for the next 10 years. And that's primarily because incremental price increase went into more drilling and more spending, not into the pockets of shareholders. And so the big question is whether the next 10 years will be more like 2000 or the last decade. And because of these 3 trends in ESG, energy transition, and capital discipline, supply side discipline, I think it's more likely that the next at least 5 years will be much better, much more benign than they used to be until recently. So now why Kistos? Basically, there are 4 key parameters. And because it's such a capital intensive sector, you really need to bet on the people behind it. And you want them to have skin in the game. So this is what you have in Kistos. The assets are actually cash rich, so these are very mature assets. And what is very counterintuitive, in oil and gas, unlike in a normal business, you don't want necessarily growth, because like if to achieve growth, you need to spend a lot. And production, the benefits come much later, and the price may be completely different. The taxes may be different. So you actually, if you have most of your spending behind you and you have a payback in the next 2-3 years, you have much less risk. It's like short-term duration, basically, in bonds. You have much less macro risk, much less operational risk. So the assets are quite good, even though there is not a lot of growth potential in them. And the last one is M&A. So because of the track record of the company, they've been good buyers of assets, and I think they can do more. So this is the main guy who founded Kistos. He is the CEO and the chairman. His main achievement was with Rockrose. I'll have a slide next on that. But the point is, on Rockrose, it was a public company. He achieved 42 times return, and that was between 2016 and 2020, when oil was touching zero and was negative at some point. So this is exactly what he did at Rockrose. So he's raised about 13 million pounds. That's in this part of the table, and he returned almost 300 million pounds in the end. So 250 was the price he received for the company which he sold, and there were additional dividends paid before that. So now what has he done with Kistos? So he had 3 capital raises. In total, he raised 100 million pounds. The market cap of the company is about just over 200 million pounds now. In 3 years, he launched it in 2020. He acquired 3 assets in 3 countries. The company is producing about 10,000 barrels of oil equivalent. That's about 3 million barrels a year, roughly 70 million, let's say, euros. They report in euros, 70 million euros of free cash flow. So for now, and about 36 million barrels of 2P reserves. So maybe not everyone may be familiar with these types of reserves, but 2P, it's proved and probable. It's the quite likely amount of volume of oil that you can extract economically. Now going a bit deeper into what exactly, how are the incentive structure, the incentive is how it's aligned. So Austin, the CEO, holds 17.3% interest in the company. He put his own money when he launched it, I think around 12 million pounds. And more recently, in 2022, he bought on the public market about 150,000 at much higher price, at £3.27. Current share price is about 250. So his last purchase was at a much higher price. And other directors, they also own shares. So it's about 1/5 of the company is in the hands of so-called insiders. These are the assets. It's basically Netherlands, Norway, and the UK. Norway is it's the names of the assets that you see in the table. It's the most recent acquisition, the biggest one. And this is the production profile. So on the website, you can see their own version of production profile, which has a bit earlier ramp up. So I think they target peak production 2025. It's a bit lower, actually. So don't use it as a kind of a formal forecast. These are just kind of estimates. But the point is, this last MIME acquisition, in Norway, it's all offshore. It adds to production growth. So it's not a declining assets at the moment. So this is the economics. So in barrel terms and in MMBTU. So to give you an idea about the economics. So Henry Hub, which is the most widely quoted price reference in North America, is about $2.50 at the moment. It was, for many years, it was at about $10 before 2008. With shale, it went all the way to like $1.50, $2, $3. So consensus is between 3 and 4. If you look at the lifting costs of North American shale guys, it's about $1, $2 plus all the transportation, dividends, interest. So it comes at about 3 as a kind of equilibrium price. Then to get it into Europe, and Europe is roughly like 50%, 60%, actually 60% is importing its energy, similar to the UK. UK production covers only 40% of domestic demand. So to get it into Europe, you spend at least, $3 in liquefying, shipping, etc. But you also need at least another 3 to build new infrastructure. So to incentivize that North American gas to come into Europe, the price has to be around $2 per MBTU. Current spot in Europe is about 12. It was, I think, as high as probably $100 or at least 50, 100.
But this in megawatt hours or even in.
I think in MBTU, but it was at least maybe 50. It was definitely at $50 in this last year, which is exceptional. Yeah, probably $100 per MBTU. Of course, we shouldn't use it as a reference point. But I think one more point to make about the gas price. I think 10 is I'm personally comfortable. It can be lower in Europe, and I think one big reason for that is a lack of storage. So in Europe, so in theory, in an efficient market, when prices are below equilibrium, you can buy it and sell it when prices go through the roof, and so you minimize volatility. But in Europe, storage capacity is only about 80 BCM, so billion cubic meters, while demand is between 400 to almost 600, depending on the weather and other sources of energy. So you can't really store gas for the winter. You still need to import gas in winter, so you can't buy all it in summer at low prices. So the point is, because of the limited storage, prices can be crazy, and that creates, in a way, opportunities because a lot of investors follow gas prices, but equilibrium prices or the long term will be much more stable than what you have on spot. And so if the share price collapses because of the spot gas price, may be a good opportunity. So I'm just looking at 26, very similar, in fact. Just different size of the chart. So it's about $25 per barrel that they make in free cash flow, and the reason being is the taxes. So I assumed UK taxes, even though big part or half of the production will be in Norway, where it's a bit more beneficial. They can basically include a lot of capex to reduce their tax liability. So the effective tax rate will be lower. So now talking about valuation. So the market cap is about 210 million pounds. They are at net cash roughly. So in terms of dollars per barrel of reserves, it's about 7 that you pay in terms of 2P, which is kind of likely amount, and 2C, which is contingent, which is subject to additional development and providing that business plan, etc. It's half of that, so $3. So the most interesting part is the free cash flow. So because the prices are so volatile, it's very hard, to use their history to say what's the normal level of free cash flow, and also their history is only 3 years old. But I estimate that. So let's say these are the gas prices here. So this is between where the equilibrium price is, and this is the oil price. So let's say at 80 and say 10, it's like 50% free cash flow yield. So roughly 100 million pounds that they should generate a year. It may differ depending on how fast they go with Norwegian asset. I think this year they are in a ramp-up phase, so it may be a little bit less this year. But even if if I'm wrong, like by significant degree, it's still at way double-digit free cash flow yield. These are the sensitivities under different gas prices in 24, 27, still very, very high. This is the schedule of events in case you want to follow. I think the biggest one will be the launch of this Norwegian asset, which is actually oil. So right now it's mostly gas, but the Norwegian assets are oil. So there will be roughly 50-50 split between oil and gas. So next year, third quarter will be the launch. But before that, the company will be releasing some additional details about the progress. And I think, so the operator is the Norwegian company, publicly listed, which they announce much more details regularly. And it seems like progress has been fine in that asset. So yeah, the way you can benefit, or we can benefit as shareholders, is they plan to start launch paying dividends from next year. They want to introduce progressive dividend policy. They can still boost their reserves, so invest in organic, assets. They can do more acquisitions, so boost their asset base through new deals. And then in theory, they can be also taken over, as was the case of Rockros, which was a publicly listed company until 2020. So I think what is the catch here? Well, of course, the tax changes. So at the moment, UK has raised to like 75% tax, the kind of total tax rate for oil companies. If Labour wins, I think there are two issues. One is they may consider further taxes, or at least how capex is treated. So whether operators can reduce, profits, taxable profits for the amount of new investments. So that may increase their tax burden. And second is the licenses. I think they want to stop new bidding rounds, so you can't buy new assets, new licenses, or the terms to extend the life of the license will be much harder. So the reserves that they have potentially may be less. I don't think it will be less than 2p that you saw, but this 2c number may not be as high. So politics may play a role here. So operationally, I think it's important that they've been a good asset sort of acquirers. They're more like bankers, less with they have less experience. I'm not saying they're bad operators, but they don't have as good experience in running the actual assets. I think one more point to make, which is very important, is this decommissioning liability. So once the field has been basically finished, like you stop producing, you need to decommission it, which is plug the wells, remove the equipment, undertake additional works, depending on where the asset is and what are the terms. So at the moment, before the acquisition of the Norwegian acquisition, it was 126 million euro liability. Yeah.
From your experience, do you think this is quite real? Do they tend, let's say, to overestimate, underestimate? That's a good question.
Yeah. That's, I think, so I never really dealt in my real life with this, because the companies I've been covering were more like integrated, and they had billions of reserves. So by the time one asset might be you were retiring it, you had so many more assets coming in. So you would never notice this. But when the whole company comes to a halt, the whole field stops, and you have no more assets to operate. So you run out of free cash flow. What do you do? That's a tricky point. Now, the most important thing is they use only 2% discount rate. So they come up with estimates of their liability, the costs to remove the equipment, and they discount those at 2%, which I think is quite conservative. On the other hand, they apply 2 or 3% inflation assumption, which is also probably a bit optimistic. The point, I think, is the timing of this. So if you do it in 2030, it almost doesn't matter, because if you can make 2 or 3 times returns or free cash flow in between, who cares? In a good way, in the sense that you can cover those costs. If for some reason you have to do it next year, then of course it's a big issue. So I think I wouldn't be too worried, because it's at least 5, maybe more like 10 years. So the more oil you find in your reservoirs, the better your production profile is, the longer you can run those assets, and the further away is the payday kind of. So I wouldn't be too worried. Yeah, the macro risks are always there. I think one big risk, of course, is the Russia risk in reverse, because the reason gas prices went through the roof last year was because roughly 2/3 of Russian gas flowing to Europe stopped. So if for some reason comes back at one point, maybe unlikely, but if it comes back, it could have the reverse impact. However, I should also note that gas prices were rising even before the war. In 2021, they were already at like $10-15 per MBTU, and that and in fact 2022 was much warmer winter. So in a way, if the winter is colder this year, with all else equal, I mean, we won't see the same level of prices, but we'll definitely see higher prices than the spot prices, because you can't buy enough gas now to prepare for the winter. So anyways, I think gas prices will be relatively high, higher than last 10 years. And I think this is a good asset in good hands, where shareholders, should possibly benefit. Yeah, these are my details. If you wanna, I have a full write-up on this on my website. I have my Twitter account. You can shoot me an email. Yeah, I think that's all. Yeah, and I'm happy to take questions. So
Yeah, that's us.
Yep.
Do this for you. Thank you. So any questions? Yeah, thank you so much for presentation. Any questions?
I've got a question about the insider ownership. You said that the CEO has like a 17% stake in the company. How did he acquire that stake? Is it the result of share options? So I've also got a second question. And also, second question is, what percentage of his entire net worth is in the company, so I can get like a gauge of how invested he is as a person. Also, you didn't kind of like you brought up his past success, but what has he done prior to that? Like you didn't go through his full background, so I just don't know if you have any more information on that.
So basically, the way he acquired this stake was from the days when he founded the company. As you can see, in terms of how much the capital was raised. So before they raised £4 million, I think he put 12 or a bit less than 12 million his own money, and then he co-invested. So whenever the company raised money, to avoid dilution, he also, not every time, but 1 or 2 times, he put his own money, not in proportion. So he put less money than his share in the company before at the capital raise, but he did invest during capital raise, and then he bought from the public market. His base salary, okay, I can't remember it now, but it's way less than $1 million, which is a lot of people receive as the CEO. So he gets, I don't know, 200,000 or something like that. I mean, it's easy to check in the annual report. So it's very modest. So his main net worth, well, I don't know his net worth, but we can probably work out from the previous deal. So he received, well, the company he founded received £300 million in total. I don't know what was his stake there. If it's similar, let's say, I don't know, 20%, so at maybe £40 million, but probably less. So yeah, I would say maybe it's like, a third of his net worth is in this company, but I'm speculating because it's not quite all transparent. And in terms of his background, so he worked as a banker and in the management consulting in the 90s in the city, and then he was one of the founders of iGas. It's an onshore gas, still publicly listed company. I think he left this in around 2015, when he actually launched the Rockrose company. Yeah, what I like about them, they don't really have any conference calls. They publish their management, like investor presentations, like once every 6 months or so. So they are a bit like Berkshire, in a sense that they don't care so much what people say about them in a good way, because they don't have a dedicated IR team, so they're not spending money on like dinners whatsoever to please sell side analysts. So although I should say Rockrose was easier because at that time there were more forced sellers in 2016, and it was a much smaller scale. So this time you already more companies are trying, like there are more private equities looking at assets, and the scale is bigger, and so they face a bit more operations now. So I don't assume you're gonna receive the same returns, and also these returns are assuming you invested at the IPO time, which is rare. So, but I still think you can at least double your money in, I don't know, 2 or 3 years probably with this guy.
Yeah.
Thanks, Mishi. I just wanted to know from your background, your experience, the difference between companies like this that concentrate on gas as opposed to oil. I just get the feeling gas seems to be far more volatile, and I've seen a lot of companies who focus on gas who are just constantly sort of undervalued, whereas the oil industry seems to be sort of in line with prices of oil. I might be wrong, but I don't know whether that's true or.
I think it's so there are two sides, basically the asset, the production side, and the pricing, the macro side. So the asset side is actually much better with gas because with the exception of shale, gas comes naturally because of the pressure. So you don't need pumps, you don't need stimulation like of wells, which you do in oil. And with oil, normally 90% of liquids that comes out is water. So you spend a lot of energy, first to pump it out, and then to separate water into like oil, and then you need also to treat oil from like impurities, whatever. So your OPEX is normally much higher. In gas, it comes naturally, and then what you also have is you have much more infrastructure, but it also means the assets normally produce longer. So in oil, you have peak production for 3 years, 5 years, 7 years maximum, and then it's steep decline, 10-20%. In gas, it can be 15 years plateau, and then it's a bit milder decline. But in terms of the pricing, I think that you're absolutely right, and that is the main issue for gas companies is gas prices, because gas markets, because they rely so much on infrastructure. Like you can have like, even in the US, there are like maybe 20 different price levels. So Henry Hub is only one. There is this Oaxaca, something like that, in Texas, when quite often it's a negative price because there's not enough capacity to take that gas out. So producers, and not to pay the penalty, they actually buy or pay people to get that gas out at any cost. And so it's because infrastructure is not so well developed, it's low density. Unlike in oil, it's a fairly high density, so it's easier to ship it, use pipes. However, the good thing about LNG now is that it connects markets, and I think there is a bit more correlation with Asia, Europe, US. I think the market is becoming a bit more transparent. Yeah, I think that's and gas. Yeah, I think people also had a view that gas is like a utility type business, and utilities are trading at like there's nothing special about them. It's boring. But I think these days it's actually good. But I think ultimately what matters is what they do with the cash. The problem is that it's such a high capital intensive business. So whenever people get money, and often they are run by engineers who say we need to do this, we need to do that, they always come up with projects, and sometimes it makes sense, sometimes maybe it makes sense as long as there is demand for 20 years, but if there is no, or the country switches to nuclear or to wind, etc., then you don't need to invest. And so this guy, knowing that he's got money in this business, I hope he won't do this sort of mistakes.
How significant is the capital expenditure tax allowance? And if Labour were to come into power, would they be looking to eradicate that allowance or just reduce it?
Yeah, so I think I'm not the best expert on taxes, and especially because they keep changing all the time. But I think it's about 70%. It depends on the assets and depends. So like if it's a new capex, so if they drill a new well and get more new hydrocarbons out, I think 70% of it can be included in the tax. Can be reduced. Can be included in your costs to reduce your tax liability. But it was only introduced, I think, very recently, maybe last year. Labor. Yeah, so to be honest, I'm not so like I'm not an expert, but one thing which makes me comfortable is that their growth capex is pretty small, like $5, and the total capex, let's say 10 per barrel. So even if you don't include those numbers, and in fact, I didn't include that. I only included half, $5 into the costs. So if you remove 5 out of this, the overall tax burden won't change so much. I think sensitivity to gas or the oil prices is matters more. That's my understanding, but I know people are worried, and I don't have like a spreadsheet which would tell me what exactly I'm working out based on the accounts, but I can't say I have 100% conviction that they will be safe. That's to be fair.
Now, Pietari, you can also be on the stage, so people can ask questions to both speakers, right? So we have a balance, right? Does anyone want to ask anything to Pietari? Okay.
There seems to be a massive difference between an investment bank business model and a retail bank. Retail banks seem to me very straightforward. They borrow money from a saver and lend it out to a mortgage, and that seems to sit. But for investment banks, there's a myriad of products, and why would you even sort of go into even contemplating investing in a company where or a bank where you just have no idea and they don't have any idea what they've invested in themselves? We're just interested in your take.
So fundamentally, it just comes down to cheapness. So if you can get the bank more cheaply than a more simple bank, then you will invest in it just because of the valuation. But yes, I agree that like retail banks, they tend to be easier to analyze. They tend to have lower beta. So when the markets go south, then you lose less money. So that's an advantage of retail banks. And there's a good reason for that, because if you look at the stress tests, which the central banks publish, then you can see that the investment banks are riskier in a severe recession than the retail banks. So the capital levels of the investment banks will be lower at the bottom of a big recession compared to retail banks. So yes, if you want to keep your money slightly safer, then it's better to invest in the retail banks rather than investment banks.
Any other questions, either for Pietari or for Ildar? Like, let's keep it balanced, but yeah. Thank you.
Yeah, this could be a question for either, because you've chosen sectors that have very high risk of government interference. And what about the last 5 years has made you more sanguine about the fact that European governments are going to be fair to companies? They'll just do what is in their interest, not in the interests of shareholders, blah, blah, blah. So how can you sort of get over these risks?
So the good news in that respect is that we've already had like 3 different governments in Europe implementing these windfall taxes. So we had Spain last year, and we saw the reaction of the Spanish banks to that tax. So they fell, I believe, about 7% on that day. And now we had the Italy situation earlier this month. So again, depending on the bank, they fell kind of little bit less than 10%, let's say. So far, the taxes that the European governments have put in place, they have not been confiscatory level of taxes. They lower the earnings of these companies by around 10%. But again, like maybe the tax is going to be permanent, maybe it's going to be temporary. We don't really know. They say that it's going to be only for 2 years, but then many people say that these temporary taxes tend to often become permanent. But at the end of the day, what I've seen is that you get the one-time hit to the share price of 5-10%, something in that range, but there's no further hit after that. So then if you buy the shares after the tax hit has already happened, then it's an okay investment. So you take the risk before the tax comes into effect. But now, ironically, in a way, in my opinion, the Spanish banks or the Italian banks are just slightly safer investment from a political perspective than some other banks where the tax has not been implemented yet, or there might still be further announcements.
Also, Ildar has a
Yeah, I wanted to ask. I want to ask. You mentioned these risks at the beginning, which you borrowed as a reference to this value invest, and I think it's quite common among value investors, not everyone, but to avoid or say that they don't invest in banks. And so I wonder if you have any counter arguments or like, because some of it makes sense to me, and I'm a bit cautious. But how you overcome those risks that the guy mentioned in his letter.
So that's a very good question, because I've also seen the same thing, that there are many value investors who will not touch banks, or at least they are not comfortable like putting a lot of money into banks. But I think for me, it's really about going to places where other people don't want to go. I mean, that's always been a fundamental plank of my investing ideology. If everybody's comfortable with my ideas, then I don't want to be there, because then I will think that the risk premium is not there. I explicitly want to go to the kind of areas which people hate. And people always hate something for good reasons. I mean, these are all valid reasons to hate banks. These are not like spurious reasons. I mean, there are like real risks involved. But maybe in my case, also, I've already lost like 30% of my portfolio like multiple times investing in these banks. And it kind of, I wouldn't say it kind of makes you immune to the risks, but it kind of like makes you feel that, okay, I've come through this already. I've always recovered from here. And of course, you put like certain risk management measures into place with these banks, because what you don't want is to lose 80% of your capital, like happened in 2008. I mean, that's already too much. So you do risk manage it with certain stops, like macro level stops, and then going into like certain types of banks only. So you avoid the kind of banks where you think that there's more elevated risk of something bad happening.
And you own a bus? Okay. So for the record, the question is, your preferred way is to own a basket of European banks, or is there one that you like the most in like one bank maybe?
It's a basket, and it's an equal weighted basket, because fundamentally these companies are analyzed by 10 analysts, 15 analysts. I, as an individual investor, will have a lot of difficulty getting like a unique insight into like any of these banks that some of these guys who follow these companies full time, that's kind of their job, will not have. So I mean, I don't believe that I have some like super unique insight into any of these banks. However, what I want to understand is that what are the drivers of the share price of each bank? Is it the interest rates? Why has the share price declined, say? Why is it so cheap now? What are the bank-specific issues? So let's say NatWest, okay, the CEO resigned. Do I think that this is value relevant or not? Is this something I care about? So I want to understand the issues, but ultimately I diversify into like a basket of 10, 15 different companies to get rid of the risk that one day you happen to be in one of these companies, which is going to be the next Silicon Valley Bank, and then you're going to lose like 100% in like one day. I mean, that's not possible when you put a lot of your entire portfolio into these banks.
Yeah.
I'd just like to understand your perspective on the oil industry. And you mentioned ESG, and there's a lot of negative around oil industry at the moment. Do you see that continuing? Do you see that because you've got a background in it, so you probably got a better idea.
So your question is the kind of the attitude, or the ESG in particular, or the more. ESG, the whole thing. Yeah, I think one idea I should say is that overall the sector is super cyclical, and whenever things look obvious, they completely reverse almost next quarter. So like remember the famous $200 prediction in 2008? Actually, same prediction from another person last year, and it never happened. And yet the price touched zero just like 3 years ago. Now it's at 80. So it changes. However, I do think this avoidance or cautiousness towards the oil and gas sector is almost more permanent. Like I don't think we will embrace the kind of the sector, the investments, there will be any kind of positive attitude at any time soon. It almost feels to me a bit like maybe tobacco, where basically people think it's bad and demand will eventually start declining, but because investments go down much faster, the pricing, the returns are actually better than before, in the opposite way, when everyone is investing, demand is rising, but shareholder returns are poor. So yeah, I think this negative sentiment will probably remain for longer. Whether it will be taxed or not, I think every government there will be a balance, and I think UK, one of the reasons I'm investing in Kistos is I think they're reasonable in a sense that okay, there may be issues, but eventually they'll find a middle way or some sort of an equilibrium, because you can't just kill the sector, but equally you don't want them to pay 100% dividends. So there should be a middle way, and that's I'm comfortable to take this risk.
Also, I would prioritize people that they haven't talked yet, or even newcomers. I mean, feel free, let's say, to ask your question or say your ideas, your opinions about banks or the oil sectors or what you. Yeah. So I would prioritize people that they haven't talked yet.
I have a further question on Kistos and specifically on the cyclicality. So my understanding is that for cyclical businesses, the timing of when you buy and you enter into certain businesses can be quite crucial on the return you get. What are your consideration on what makes this moment a good moment to enter into Kistos? Or
yeah, I think no, it's definitely a good point. And even though we try as value investors to ignore macro, to focus on bottom up, like these commodities, for them macro matters way more. Why I'm comfortable is that while I do think the prices will fluctuate and maybe be down at some point, I don't think we will have a constant period of low prices. For reasons such as lower capex, capital discipline, and inflation. To me, Dimitris was asking what's kind of your feeling about the markets, and I'm actually not old enough to remember the 70s. I was born right after, but I for some reason I think we are more like in the 70s. So inflation may be a bit more permanent, and commodity prices generally do well in the inflation period. And so I do think that the prices will be in a stronger kind of range bound, but in a stronger than, let's say, last 5 years. And more importantly is the fact that share price is actually way below. So they spiked last year. So last year I was a bit careful because I read from all over, every paper every blogger would say buy oil. To me it was speculation, just because the market price was going up, maybe it goes down tomorrow. So why do you want to buy it? But once I got comfortable that companies have changed behavior, I don't think it will change so quickly in terms of focusing on supply, meaning not to overflood the market, and the free cash flow. So yeah, that's what makes me comfortable. So I think it's a good time in the sense that share prices are down, prices will probably stay high for commodities.
We can continue about 5-10 minutes with questions, and then we can switch off and we can continue offline, like unofficially, right? But we have like 5-10 minutes if there are more questions or some parts that we haven't covered and you want to cover. Because I mean, we are lucky today that we have like two people that they specialize, in those fields. So I guess that some like questions about those sectors like banks or oil and gas industry, we may get some good insights. That's why I'm keeping the conversation. So if you have any other questions, otherwise we will after a while we will switch off and we will move to just mingling. Yeah.
You mentioned about the basket of European banks that in the next 1 to 2 years, it's likely you can make a lot of money or you can make a lot of money. Do you have a view beyond 2 years, 3, 4, 5, 10, 15, 20 years? Because you've already seen that the sentiment hasn't shifted when interest rates have gone up and they're earning more money. So who's to say the sentiment will change and PEs will expand in the next 1 to 2 years? But if you believe that the stock market, a stock price will track the earnings growth of the business over an extended period of time, then you could, think in the next 10 to 20 years you could make money by owning bank stocks.
So I'm generally a pretty short-term investor. So I care about the next 1 to 2 years, 1 to 3 years. And I don't know where these banks will be in 10 years or 20 years. I mean, I think that the competitive headwinds are there, definitely. And some of them might potentially become serious. Although it's also true that it's the areas which are the easiest to disrupt that have been disrupted to date. So if you think of something like Revolut disrupting kind of the retail FX card payments, like Wise, like FX transfers, like these neobanks like N26, Monzo. I mean, these are all areas which are easy to disrupt with technology. And I think that is the reason why like these areas have been disrupted first. And I think there's a lot of other areas which will be a lot more difficult to disrupt, like lending, like lots of the investment banking activities. They are not as easy for like new entrants to enter just like that and scale like these like technology like led players have done in the retail banking space. So I don't think like these existing banks are going to disappear anywhere over the next 10, 20 years, certainly in the investment banking space. But as to whether they will be good investments, then I don't know. What I'm waiting for is just the kind of normalization of earnings or the normalization of valuations to some more reasonable level. If that happens, then I'll probably move on to the next thing, whatever is cheap, like at that time.
Anyone else? Okay. Yeah.
Sorry, question for Ildar. I know you said you're not a tax expert. I was just looking at the accounts here, and they show that they have, well, this tax expense is the massive thing. So they've got revenue from 2022, revenue of 411 million, operating profit 276 million, profit before tax 254 million, and then total tax charge of 228 million, which leaves them with a profit of 25 million. Okay. And then on the cash flow statement, they back out the entire charge of 228 million and only pay tax of 65 million, which leaves them massively cash flow positive. Like they have 290 million from operating activities. So that makes them look like their free cash flow is really high. are they going to eventually just be able to push this can further and further down the road, or do you think that 228 million is eventually going to come due because governments are going to go, look, we want our windfall?
You're well equipped with, with all the tools.
Yeah. Proper due diligence. So I think there was 45 million euros out of this number was from the so-called solidarity tax by the Netherlands, which they challenged. So they haven't paid it because they say one of the fields was something like launched like the tax does not apply because it applies to all the fields or bigger fields. We just launched production recently and it's too small. But we don't know. So that's a question mark. Yeah, so this 45 can be deducted, which to me is okay because I think it was it's a short term, this solidarity. I think it was only 2022. And given the free cash flow going forward, it should be okay, manageable. Yeah, the remaining part is a good question. Yeah, and it's still massive. I would think a big chunk probably will have to be paid. So it's a bit of a working capital. So it's kind of incurred during the period but paid later. Yeah, to be honest, I need to look into more detail in that. Yeah, I don't know to have a very specific question. But my sense was that when I tried to work it out, I think it was coming similar to the headline number of 75% effective tax rate. So I think the numbers you quoted suggest more like 90 or something. So maybe there was something related to like, I don't know, one-off like acquisition or I don't know. I doubt it will be similar going forward. And also with Norway, which will account for roughly half of their production from like in 18 months, they have much better tax regime because a lot of the capex can be expensed. So I think that will balance, offset some of the risks. It's actually one of the reasons they went into Norway after UK and Netherlands have raised their taxes. That's a very good question. Yes.
Okay, I have also a question. If nobody else want to ask anything, so you both are experienced in sectors that they are quite aggressive. And as an investor, I like this asymmetry that if you diversify a lot, when you lose, okay, you lose. But when you win a lot. So even if you lose half of the time, you may do really well. And that's true for the banks and also for there are different ways why they are so aggressive sectors. But what I have found when I invest in aggressive sectors that they have this asymmetry is that you expect that, but because things are really unpredictable for different reasons for those two sectors, the times that you lose, and the times that you're about to win, you lose your confidence. You are sometimes, I don't know, you get confused, and you don't get, like the winners don't give you this 5x or 10x that they should give you, and the losers will give you the losses. That's my personal experience, where I struggle and where I'm trying to become better. So have you found the same thing? And I'm asking both of you, and how you deal with that, and if you have found. I'll start with Ildar, and yeah, next to me.
Okay, I was hoping Pietari will start, but because the reason what is it? So I got the first half of the question, and then the second. So when you win, you don't win as much, or
The reason is because probably things are so unpredictable, so you lose your confidence. So the loser, you lose, but for the winner, let's say, things get a bit unpredictable, and you say, things are not going as they should. And then you sell, for example, that's how you lose the gain. But then this becomes a 5x.
No, to be honest, so it's a very good question, and I did suffer from this before. I lost a lot of money in an offshore driller, Ensco, which is now Valaris, which made me think that, okay, I'm never going to invest in oil and gas again. And also because as I was covering, the stocks have been underperforming. Everyone wanted a bit of technology, a bit of consumer, hot, growing, etc. And I also saw the way the companies are run in oil and gas. These priorities are assets like pipelines, wells, etc. So I think one solution is really diversification in the sense that you don't want to own too big of a position. So Kistos, in my case, is like 1.5 max. I need to double. It's between 1 and 2, but less than 2. And I don't want to go further. Because there are other cheap ENPs here, which I'm still doing more work on, like Serica, which actually pays dividends, and Harbor Energy. But yeah, I think it's having small positions makes sense. Then you don't really want to bet on one single name. But also, it's the who are you partnering with? So I'm comfortable with Austin, the fact that he has his money there, and he should look after that company.
So the way I manage that is that I want to keep invested if things, in my view, are going in the right direction. It doesn't matter like what the level of things are. I mean, things can be like really bad, but if I get the feeling that they are going in the right direction from a macro perspective, then I'm happy to invest in the banks. On the other hand, if I get the feeling that things are going in the wrong direction, and on top of that, things are becoming so much uncertain that I can't anymore model what's going to happen, then I'm actually going to become very cautious, and I'm going to sell my holdings, or at least reduce my risk. So that is how I manage that. So just to give some concrete examples of that, in March 2020, when COVID was spreading around the globe, I sold all of my bank holdings, like all of them. I just dumped them at like 30% loss because I didn't know what's going to happen. And actually that was a good decision because it was made in early March 2020. And then I bought the same stocks back in April 2020 when I felt that, okay, the situation is really bad, but it has stabilized and maybe the only way from here is up. So in the same way, like if you take the example of March this year, when the Silicon Valley Bank problems arose, I actually reduced my bank risk very fast, very significantly, like as soon as that problem broke out, because I couldn't model it. I didn't know what's going to happen there. So when these kind of things happen, as a bank investor, you become super cautious, like having seen like what happened in 2008, and then how much money you can lose and how quickly. And then I went back into the banks in, a few weeks later when I got the feeling that, now we know like what is the scope and scale of this issue with Silicon Valley Bank and the other failed banks. And now I can somehow model it, at least model it in my mind. What is the impact of this? So that's the way how I manage like that problem.
Thank you both for your answers.
I had a bit of a follow-up question on the cyclicality and all you said about the risks of commodities and my question was, have you considered like different buying strategies because of the cyclicality? Because I mean, I was just thinking, for instance, what happened in March, April 2020, and you look at where Shell and even BP, I mean, all these businesses went down. I think BP at the moment is about 470, and I think it went down to 200 pence, something like that. So have you considered this type of strategy? So again, similarly to what we were saying about coming in and out of these businesses, because clearly the cyclicality, I mean, there's such a correlation between oil prices and the prices of the shares. I mean, you look at it and it's shocking when you look at BP and Shell. And but obviously, if I don't know, if you consider something like that, where you look at maybe at the benchmarks and look at historically what happened.
A bit of a difficulty with the large caps is that they are more diversified, so they have refining business, which actually did relatively well in a period when, not in 2020, but 21, 22 was phenomenal, when oil price was still low, 21 or late 2020, yet demand was picking up. They made so much money. So, and the other thing is the stocks never priced in zero oil price. So physical commodity is way more volatile because there is less ability to hold inventories. Like it's expensive to hold. If everyone buys oil for speculation, freight rates go up. While in stocks, people can hold stocks. It doesn't cost much for 5 years even. And so prices of stocks normally reflect some sort of equilibrium, long-term equilibrium price. So it's a bit harder with large caps. With small caps, I guess so, but my experience hasn't been so good in a sense that because with drillers, for example, yeah, like I think a lot has to do with the balance sheet. So if the balance sheet is stretched, like a lot of the drillers have, they cannot sustain low rates for, I don't know, 1, 2, even 1, 2 years. Depends on the balance sheet, but at some point they will have to raise capital, etc. So I wouldn't speculate with names that are levered, even though they are the most sensitive to this. But like with Kistos, with no debt essentially, or some other, it's easier to do. Yeah, and I think maybe I haven't introduced the rule, but I think maybe if it goes down 20% and the kind of macro broadly is similar, maybe I should just force myself to buy. In fact, this is a good question on rules based, because I've been doing a lot of research on like not so necessarily AI, but just like general like decision making. And I think humans really make mistakes, not in assessment, but kind of in implementing and having the discipline. And like if you have rules, like machines sometimes beat the humans not because they're smarter, because they're consistent. And so I think it's something I'm thinking of doing, even though it sounds basic, but I might do it. Yeah. And the other thing is, of course, taxes. Like the more you do up and down, unless it's an ISO or some sort of a yeah. But it's a very good. Yeah. But basically, stick with low debt, strong balance sheet companies, and then maybe you do a bit of buying a lower and selling high. I think it's safe.
So I think we can finish here, and we can continue the conversation. Okay. So today, people, I am excited for two reasons, and I'm a bit disappointed for one. I will start with what I'm disappointed. I'm disappointed for the streaming. We have an issue with the internet. So it's the third time that the stream is interrupted. I feel a bit disappointed about that. But I'm really excited for two reasons. And one reason is that we have two specialists here, and I really enjoyed and we learned a lot. And the other is you, that you come here, you support us, you participate, and like the previous time, it's a full room of people. So I'm really excited about those two. So let's a big round of applause for the two speakers. And thank you so much for coming. And I'll see you next time.